Today I'm going to cover the difference between renting and buying, and I'm going to cover it in central New York. If we were in California, I'd be giving you the exact opposite pitch. Today we're going to talk about school tax relief, or just tax relief in general, a lower interest rate, and the fact that you have no management fees or profit attached to your monthly payment. And then we have the fact that you can capture equity both through inflation protection and also through appreciation. Simply because with a good bank loan, you really have all these rights that the banks don't have anymore, and options and ways that you can kind of use that to your advantage. So let's go right off the bat here with school tax relief, and this is again something for just central New York here. School tax relief is what they call STAR. The basic STAR means that if you live in the house and you're the owner of the house, in other words, you're the owner occupant, then you can get a very significant, usually in the type of properties that we're buying, we're usually looking at about a $55 to $60 a month difference in your taxes, just based off the fact that you are the owner occupant. So obviously if you own it, it's going to be less on your payment every month. Also, if you're a vet, you can take 15% off of your county taxes, and that can also be quite significant. So lower taxes, also the fact that you can deduct the interest on your mortgage, that's also huge. Let's go right to interest rate. This is one where, as you know, I'm an investor. When I'm investing in a property, we get a much, much higher interest rate from the banks or even from our private lenders. We're generally around 2% higher these days than you would be able to get if you went to get a normal FHA loan. So obviously that is going to be passed on to you as a renter. You know, we're not going to pay that. We're going to pass that on to you. So that's why your rent payment is considerably higher than it would be if you own the property. So you will get a much better interest rate, because think about the banks. They're going to always say that you're a much better risk. You're always going to give up your rental property or your investment property before you give up the one that's over your head. So they pass that extra risk on to us as investors by adding a couple of percentage points, and we have to pass that on to you. Another thing we need to pass on to you is management fees. So in any rental, you're probably going to be paying someone for management fees, or even some derivative of that. So they're going to be assuming that there's going to be some maintenance on the house, so they have to add that to the payment also. So again, that's going to be added more, and sometimes also as profit here, that's going to be added to your monthly payment. Now the biggest thing, as far as I'm concerned, is capturing equity. It's great that it's less per month. I love that. But capturing equity, in other words, if the house goes up, you have a $100,000 property, and the house goes to $200,000, well, let's say over 10 or 15 years, then that should be your money. Now realize that that can happen by a couple of different ways. One is the value of the dollar can go down, so everything goes up in value. All right, that's fine. That's unfortunate, but that's just the way that it works. So everything is going to become more expensive, including houses. But here's the beauty of that. If you have a mortgage, the bank can, with a good fixed rate mortgage, which is what I want people to use when they're buying our properties, the bank cannot just decide that, oh, well, since it's a lot more expensive for everything else, we want your mortgage balance to also go up. They can't do that. We're in a country, in fact, the only country in the world that has fixed 30-year rates. Go to Canada, Mexico, anywhere else in the world, and they'll look at you with that funny look and go, why would anyone fix interest rates for 30 years? And yet that's normal in our area. You should be taking advantage of that. Now think about this. You cannot get a mortgage and then 3 years down the road, the banks say, well, we're going to charge you, instead of 5% interest rate, we're going to charge you 8% because that's what our prevailing rate is. They can't do that. In other words, you're held at a certain interest rate, and you can refinance if rates go down, but they can't basically refinance on you and start charging you more, again, if you're using a fixed interest rate. So that is really where I see equity happening, that you have a fixed, not only fixed payments, but also a fixed mortgage balance, which will be going down, while the value of the property can be going up considerably. So that's what I call about capturing equity. It's a huge inflation protection, because inflation gets completely out of control where let's say a $100,000 house goes to $1 million. Well, you're locked in at that mortgage level, which is probably less than $90,000 at that point. So that is huge equity protection for you, and also an inflation hedge. So remember that the price can go up and the mortgage will be going down as you amortize it. Even if it's interest only, the mortgage value will be going down as the value of the dollar drops. Now, the payments themselves will be fairly level. The principal and interest will be staying level, but the taxes and insurance will go up slightly. Even though your taxes, I'm saying year over year, they'll go down or they will go up slightly. So your payments, although what you're actually writing from your checkbook, are going to be going up a little bit with tax and insurance. The principal and interest, which are the big ones, are going to be pretty much the same. And again, that is also going back to taxes, that interest is going to be deductible. So I hope I've given you, without throwing any numbers out here, some of the reasons why I think it's a whole lot better in central New York. I'm saying in central New York, not in California or some other places that have really high expensive real estate. It makes a lot more sense to do it here in central New York than it would in California. In fact, one of the investors, you may be living in one of the houses right now, he lives in Santa Barbara, California, and he's renting a house. He's a really smart guy, and he's renting his house. If he were here, he would obviously never do that. But in California, it just makes more sense. In future videos, I will break out a calculator, and we're going to go through the tax relief and the lower interest rate and some of these management fees, and really show you how much less it will be per month with a typical house in our program. Stay tuned.